Okay, let's unpack this. It is Wednesday, January 21st, 2026. The markets are waking up, coffee is brewing. And while most headlines are chasing the usual tech giants, there is a different story playing out in the financial sector that I think tells us a lot more about the actual state of the economy. Interactive Brokers ticker IBKR dropped their Q4 2025 earnings after the bell yesterday.
And the market really liked what it heard. The stock popped over 6% in extended trading. But frankly, the stock price movement is the least interesting part of this report.
I agree completely. We aren't here to tell you to buy or sell the ticker. We are doing this deep dive because Interactive Brokers acts as a unique barometer. It isn't your typical retail brokerage full of meme stock traders just guessing on price action.
No, not at all. It is traditionally where the smart money lives. Hedge funds, proprietary trading groups, financial advisors, and, the really serious individual investors.
Exactly. If you want to know what the sophisticated money is doing, you look at IBKR's metrics. And looking at this Q4 report, the press release, the 8K, especially the transcript with founder Thomas Peterfy and CEO Milan Galic, the sophisticated money is incredibly active, and they are winning.
They really are.
So our mission today is to parse this record-breaking year. We need to explain how they are generating margins that frankly shouldn't be possible in a commoditized industry, and we need to look at this claim, which I honestly had to reread 3 times, that their clients are actually beating the S&P 500.
That statistic alone is worth the price of admission today. It just flips the entire narrative of retail versus institutional on its head.
We will definitely get there. We also have to talk about their expansion into prediction markets, which is a fascinating strategic pivot. But let's start with the financials. They are calling this business a money machine. And when you look at the numbers, it is hard to argue with that label.
It's a financial fortress. For the full year of 2025, they cleared over $6 billion in net revenue. That is a historic high for the firm.
A record, yeah.
And if you zoom in on just the fourth quarter, the one that just ended, they brought in $1.67 billion in adjusted net revenue.
And to put that in context, Wall Street was expecting about $90 million less than that.
Yep.
So they beat on the top line comfortably. But I was looking at the bottom line, the adjusted earnings per share. They posted $1.65 against a consensus of 50 cents.
That is a massive beat.
It is. But as an analyst, I always try to look past the headline beat. Anyone can engineer an earnings beat with buybacks or one-time tax credits. What jumps out at me here is the quality of that revenue.
Yes. The margin.
The margins are just,
Right. So in the financial services world, if you were running a brokerage or a bank, a 30% or 40% pre-tax margin is considered, the gold standard.
Right. That is usually the ceiling for a well-run firm. Goldman Sachs, Morgan Stanley, They would kill for 40% consistently.
Exactly. IBKR's pre-tax margin for the quarter was 79%.
79%.
For the full year, it was 77%.
That is absurd. That is software as a service territory. That is NVIDIA territory. That is not financial services. How do you maintain a 79% margin in a business that involves clearing trades, global compliance, customer service, and holding client cash?
You do it by not being a traditional financial services firm. You have to view IBKR as a technology company that happens to sell brokerage services. The key metric here, and this is the secret sauce, is operating leverage.
Define that for us in this context.
Sure. Operating leverage is essentially the ability to grow your revenue and your workload significantly faster than you grow your expenses. In 2025, IBKR grew their total accounts by 32%.
Okay.
They added over 1 million net new accounts. That is a massive influx of logistical complexity.
Usually that means a hiring spree. You need more support staff to reset passwords, more compliance officers to check IDs, more middle management.
Precisely. In a traditional bank, headcount tracks closely with customer count. But at IBKR, while accounts went up 32%, their headcount only grew by 6%.
32% growth in customers, 6% growth in staff.
That is the automation gap. And CFO Paul Brody talked about this specifically. They have automated the back office to a degree that their competitors simply haven't. They don't have thousands of people answering phones or manually reconciling trades. The platform does it. The code does it.
And that's how you get to keep 79 cents of every dollar of profit.
That's it. It's an incredible model.
It really challenges the assumption that you need linear growth in overhead to support a growing user base. But let's pivot from the company to the users themselves. Because you can have a great, profitable company, but if the clients are losing money, eventually that churn is going to catch up with you.
And that is the prevailing narrative in retail trading, isn't it? the dumb money. The idea that retail investors trade too much, chase trends, buy at the top, sell at the bottom, and ultimately underperform the index.
Right. The academic consensus is usually that retail provides liquidity for the pros to eat. But there was a section in this call that completely flipped that script.
It caught me off guard, too. They broke down client performance for 2025. Now, you have to keep in mind, 2025 was a good year for the market. The S&P 500 was up 17.9%.
Solid returns. If you just bought an index fund and went to sleep, you made nearly 18%.
A great year. But IBKR's individual clients, just the regular people, not the institutions, were up 19.2%.
So the retail crowd on this platform beat the S&P by over a full percentage point.
Correct. And if you look at the hedge fund clients on the platform, they were up 28.9%. That is significant alpha.
Alpha being the return generated above the benchmark. So the million-dollar question is why? Is this just a lucky year, or is there something structural about the platform that helps people trade better?
Well, we have to be careful distinguishing between correlation and causation here. But Nancy Stube, the director of investor relations, was pretty adamant about the cause. She used the phrase, no gimmicks, no games.
Which feels like a direct shot at some of the app-based brokerages that became famous a few years ago.
It absolutely is. Think about the gamification of trading confetti exploding on your screen when you buy a stock, push notifications nudging you to trade options because the market moved 1%. That drives volume, which is good for the broker,
But terrible for the client.
but usually drives poor decision-making for the client. IBKR is saying, we don't do that. Their argument is that by focusing on lower costs, literally saving pennies on execution and avoiding high commissions, those savings compound.
The drag argument.
Exactly. If you pay high fees or get bad pricing on your trades, you are starting every race 10 yards behind. IDKR's execution engine, which they call IB Smart Routing, hunts for the best price across dozens of exchanges. If you save $0 or 2 cents a share on 10,000 shares and you do that 50 times a year, that adds up to real money.
It also suggests a self-selection bias, doesn't it? The type of person who opens an IBKR account, which historically has a steep learning curve, is probably already more serious and educated than the person opening an account on a gamified app.
That is definitely a factor. This is a platform for people who do the math. They aren't there for the user interface confetti. They're there for the execution price. It attracts a certain psychographic.
So let's talk about where these people are coming from. You mentioned 1 million new accounts. IBKR is sitting at 4.4 million accounts total now, with client equity hitting $780 billion.
Nearly $1 trillion. It's up 37% year over year. That is massive asset gathering.
Is this growth mostly domestic? I feel like I hear about them more in the U.S., but they've always had an international flavor.
It is heavily global, and honestly, that is their biggest competitive moat. If you are a brokerage in the U.S., it is relatively easy to set up shop. But try setting up a brokerage that seamlessly handles trading in Brazil, Taiwan, the UAE, and Slovenia all at once.
Did they open all those markets in 2025?
They expanded access to all of them in 2025, yes. But it's not just about letting people trade U.S. stocks, it's about localizing the account types. This is the boring, gritty compliance work that actually matters.
Give me an example of what that looks like.
Okay, take tax-advantaged accounts. In the U.S., we have the IRA. IBKR supports that. But in Canada, you need an RRSP. In the UK, it's an ISA. In France, a PEA. And they just added the NISA for Japanese investors.
So if I'm an expat living in Tokyo, or just a Japanese citizen, I can open a local tax-free account on IBKR, trade global stocks, and have the tax reporting handled correctly.
Exactly. And frankly, very few competitors are willing to navigate that regulatory spaghetti. It makes the platform incredibly sticky. Once you have your tax-advantaged retirement funds sitting there, you aren't going to move them on a whim.
Speaking of stickiness, I wanted to ask about this credit card they launched in October, the Carta Visa Infinite. It sounds like just another rewards card, but the mechanics seem different based on the 8K.
It ties your spending directly to your portfolio. It allows you to borrow against your brokerage balance instantly, anywhere in the world.
So instead of selling my Apple stock to pay for a vacation and triggering a capital gains tax event, I'm just taking a loan against the stock.
Right. And because it's IBKR, the margin rates, the interest you pay on that loan, are typically much lower than a standard credit card APR or a personal loan. It integrates the investment life with the spending life.
And it's also a liquidity problem.
Exactly. Wealthy clients don't want to hold cash. They want to be fully invested. This card lets them stay fully invested while still buying dinner in Paris or a new laptop in Singapore. Again, it locks you into the ecosystem.
You're not leaving.
If your credit card bill is being paid by your portfolio margin, you are never leaving that broker.
Now, we have to address the elephant in the room regarding interactive brokers, the user experience. For years, the knock on them was that the platform was built by geniuses, for geniuses, and if you didn't have a PhD in computer science, good luck figuring out the interface.
The learner persona. We know this well. The desktop platform, TWS, is legendary for being powerful, but incredibly dense. It scares people away.
But looking at the 2025 roadmap they executed, it seems like they're trying to bridge that gap using AI.
They are. They realize they can't dumb down the tools. Their core clients would hate that, but they can make them easier to access. They launched Ask IBKR this year.
Which is what, exactly? A chatbot.
Think of it as a natural language interface for your portfolio. Instead of clicking through 5 submenus to find a risk report or a tax document, you just type into a box. You can ask, what are my top dividend payers? Or show me my capital gains for Q3.
That is a huge quality of life improvement. It turns a database query into a conversation.
And they took it a step further with AI investment themes. This is for the discovery phase. Let's say you believe nuclear energy is going to boom, but you don't know which companies are involved.
I type in nuclear energy.
And the AI generates a curated list of actionable stocks, ETFs, and related instruments. It democratizes the research process. You don't need to know the tickers anymore. You just need to identify the trend.
I noticed they also threw a bone to the hardcore tech users, the nerds, if you will, by finally releasing a Linux version of the desktop platform.
Which, ironically, probably generated as much excitement in their core user base as the AI tools. It shows they aren't abandoning the power users. They are trying to widen the funnel at the top with GlobalTrader 2.0 and AI, while keeping the engine robust for the quants who run Linux.
Okay, so the core business is firing on all cylinders. But let's look at the strategy. During the Q&A, management dropped 2 major developments that signal where they want to go next. The first one is banking. They applied for an OCC National Trust bank charter.
This is the holy grail for a broker.
Why? They already hold my cash. They already give me a credit card. Why do they need to be a bank?
It comes down to custody. CEO Milan Galic explained this well. Right now, as a broker-dealer, they face regulatory limits on acting as a custodian for certain assets, specifically mutual funds and ETFs that are held outside of the brokerage.
So if I have a bunch of old mutual funds at a different bank, I can't easily just drag and drop them into IBKR?
Yeah. There is friction. You might have to liquidate them, move the cash, and rebuy, which triggers taxes. If they get this charter, and they are hoping to be operational by the end of 2026, they can custody those assets directly.
It effectively removes the barriers to consolidation. I can take my entire financial life from every other bank and broker and dump it into IDKR.
Exactly. It becomes a true one-stop shop. And once you are there, with their interest rates and margin capabilities, you are very unlikely to leave.
The second strategic play is a bit more exotic. Prediction markets. This is founder Thomas Peterfy's passion project, ForecastX.
This is a fascinating area, but we need to distinguish it from what you might be seeing in the news with platforms like Kalshi or Polymarket.
Right, because there was just that big ruling in Massachusetts regarding sports betting contracts.
And Peterfy was extremely explicit about this in the call. He said, we are not going to do sports betting. He wants nothing to do with the Super Bowl or the World Series. He sees that as gambling, not investing.
So if I can't bet on the Chiefs, what am I trading on ForecastX?
You are trading on economic indicators and, interestingly, climate events. He mentioned that their most traded contracts right now are temperature contracts.
Temperature contracts. Explain the utility of that. Who is trading the weather?
Utilities and energy companies. Think about it. If you run a power plant, your profitability is entirely dependent on demand. If it is a scorching hot summer, everyone runs their AC and demand spikes. If it is mild, demand drops.
So they're buying these contracts as insurance.
Precisely. It is hedging. If it's a mild summer and they sell less electricity, the profit from the prediction contract offsets the loss in revenue. Peterfy mentioned they are working on tying these temperature contracts directly to electricity and natural gas contracts.
That is a sophisticated B2B play. It's not gambling in the retail sense. It's risk management for institutions.
Exactly. It's now running 24/7 with over 10,000 instruments. It's still a small revenue stream, but if they can capture the corporate hedging market, the volume could be immense.
We've painted a pretty rosy picture here. High margins, happy clients, new tech. But as analysts, we have to look for the tracks. What keeps the CFO up at night? What are the headwinds for IBKR?
The big macro headwind is interest rates. We cannot ignore that IBKR is, in part, an asset-sensitive business. Their net interest income, the money they make on the cash, sitting in client accounts and margin loans, was $966 million just for this quarter.
That is roughly half their revenue.
Right. And that number is high because interest rates have been high. But the Federal Reserve is in a cutting cycle.
So as the Fed cuts rates, that $966 million starts to shrink.
Paul Brody actually gave us the math on this. He estimated that for every 25 basis point cut in U.S. rates, IBKR's annual net interest income drops by about $77 million.
That is not a small number. And if other central banks cut rates too.
Add another $31 million hit for non-USD rate cuts. So a global quarter-point cut is roughly a $100 million revenue headwind.
Is there a counterbalance to that?
There is a natural hedge. When rates go down, borrowing money becomes cheaper. So clients are more likely to take out margin loans to buy more stock.
Ah, so they lose on the yield they earn on cash, but they gain on the volume of lending they do to clients.
That is the hope, and the data supports it. Margin lending balances were up 17% this year. The bet is that a risk-on market environment, fueled by lower rates, will increase trading volume and margin borrowing enough to offset the drop in interest income. But it is definitely a risk factor to watch.
I also wanted to ask about crypto. It feels like every fintech company is pivoting to become a crypto exchange. Is IBKR betting the farm on Bitcoin?
Definitely not. And honestly, it was refreshing to hear CEO Milan Galik's take on this. He was very cool on the topic. He basically said crypto is a small part of their revenue.
He didn't try to hype it as the future of finance?
Not at all. He noted that their core clients, those sophisticated investors and hedge funds we talked about, aren't really asking for it in a major way.
That is telling. The smart money isn't banging down the door for altcoins.
IBKR offers it to round out the platform so an advisor can have a 1% allocation if they want it. But it's not a growth engine for them. They are staying focused on stocks, options, futures, and bonds, the serious asset classes.
It reinforces that no gimmicks brand identity we discussed earlier.
Yeah.
They aren't chasing the latest hype cycle. They are building infrastructure.
Which brings us back to the sustainability of this model. You have a company growing at 30% with 79% margins. The question everyone asks is, how long can this last?
That was actually my favorite moment of the earnings call. An analyst asked Thomas Peterfy, who is in his 80s now, how long he thought this 30% growth rate could continue.
It was a classic Peterfy response. He didn't hesitate. He said, as long as I shall live.
Confidence is just off the charts.
It's not just bravado, though. It's a belief in the logic of the market. His view is that if you offer the lowest price, the best execution, and the widest global access, eventually everyone who does the math must come to you. It's inevitable.
So here's the final thought I want to leave our listeners with today. We started this deep dive talking about the gap between retail and Wall Street. For decades, the assumption has been that the institutions have the edge. The Bloomberg terminals, the high-speed data, the inside track.
Right. The playing field was never level.
But we just looked at data showing IBKR's retail clients beating the S&P 500 and hedge funds on the platform crushing it. If these tools, AI analysis, institutional-grade routing, global access, are now in the hands of the individual, does this signal a shift?
It is a profound question. When everyone has access to the same AI and the same global markets, the edge doesn't come from access anymore. It comes from judgment. And it seems IBKR is betting that their clients, the ones who self-select for this complex platform, have the best judgment.
The democratization of weapons, essentially. Fascinating quarter to kick off 2026. Thanks for taking this deep dive with us.
Always a pleasure.
And to our listeners, keep analyzing, keep learning. We'll see you on the next deep dive.